Wow. Okay. So this is the last session of the first class. Okay, the fourth one. The active monetary and fiscal policy discussed here would not be possible without these watershed moments in the early 20th century. For example, the creation of the Federal Reserve enabled the federal government to more directly control the money supply. More recently, the Federal Reserve has expanded its role in economic stabilization by serving as a lender of last resort. And it targets certain interest rates. Also, the enactment of the federal income tax eventually became an important macroeconomic management tool. Aside from collecting revenue for the federal government, it can serve to stimulate the economy either through changes in tax rates or through refundable tax credits, as was the case with the CARES Act discussed earlier. So the federal income tax is a mechanism for economic stimulus. Finally, because the federal government collects trillions of federal income tax, these revenues can be used for direct expenditure on the part of the US Treasury. Alternatively, government can indirectly increase the C term, private consumption expenditures. It can do this by enacting refundable tax credits or otherwise making direct payments to taxpayers. Although some recipients of stimulus funds might save money, it is presumed that most recipients will spend the funds, which would increase the extent of aggregate demand in the economy, which increases the GDP. So C here, private consumption, I is private investment, and G is government expenditure, X minus M are net exports, where GDP is national output. To add some layers of complexity to this scenario, we begin to contemplate what happens to this scenario when not everyone realizes a net benefit from the project, and what happens when we ask different individuals to pay differing amounts. In this example, too, in contrast to the previous example, the project may proceed if the community sets a majority vote, but some homeowners realize a net loss if all residents are asked to pay a pro rata share of the project. So 4,000 each, 4,000 per individual like that, cost share. This violates the Pareto criterion, which specifies that no one should realize a loss from the project. Okay, so here you remember individual benefits different and cost share is the same. So individual gain is different. How about example 3? So in example 3, the contribution of each homeowner is adjusted from a pro rata share to a share of benefits received. So individual benefit is different. Cost share 2,500. Individual gain different. So individual share of benefit is different. The Pareto criterion is no longer violated because each individual realizes a net gain when the contributions are adjusted according to benefit. The Pareto criterion is used to assess whether a policy or decision is beneficial. If a change to policy or economic arrangement results in at least one person benefiting without anyone else being harmed, then that change is considered to meet the Pareto criterion. Attention should be focused on the difference between cost share and benefit-based cost share. So 1,875, 3,125, 5,108, 175, 625. Suppose that the size of the benefit is amount of the damage averted from flood protection from the levee. This system of financing the levee is similar to that of the property tax, which is prorated according to one's share of property wealth in the taxing justification. To summarize, we've covered the basic principles of public finance, the role of government in the economy, the differences between public and private finances, and the importance of understanding public budget. We've also discussed fiscal policy, public goods and services, market failures and government intervention, privatization, and financial sustainability. Now, I'd like to open mm, the floor for any questions you may have. Feel free to email me about this slide sets. I'm gonna post this video on YouTube and send an announcement about the links on campus. Thank you.